Now, in traditional investments theory, we try to build an investment portfolio with various types of assets, but we're not really focusing on the end goal of building that portfolio to fund something that we're going to be spending that money on in the future. How do you match an investment portfolio to a specific goal?
Right, so the most common method that advisors use to build portfolios is called mean variance optimization. Really all it is you have these assumptions about the returns and risks of different asset classes, okay? The problem with building portfolios that way is that you aren't thinking about explicitly the risks of the goal. So let's just say that I have a goal of funding college, okay? And college costs have increased by inflation by a considerable amount. So inflation is a really big risk factor for funding college. And so, if I run an optimization, it may put all the money in nominal bonds. Well, in reality, inflation-linked bonds are a much better hedge against the risks of college inflation. So if you run it a different way, actually putting the risks of college into the actual optimization, you get a very different portfolio.
So in other words, you're saying that we could have a portfolio that is efficient, that provides the highest return for a given level of risk, but will not help us necessarily meet our specific goal.
Right.
That we could change the characteristics of the portfolio in a way that would allow us to meet that goal. And if we're talking about something like education funding, there's probably strategies that we can use that better hedge the inflation or better protect ourselves against the inflation increase in the price of education.
Right, another example, that it's a bit loose, but let's say that they wanted to buy a second home. Okay, you could invest in a normal portfolio, but if you want to maybe hedge that liability, you could invest in a portfolio of real estate investments. You could think about, okay, well, what is the best asset to hedge the risk that, hey, if the home goes up in value, what will also go up versus down? And the key with this approach is not maximizing wealth, it's minimizing volatility around funding that goal.